Did you know that there's an index that tracks fear? Not in stocks, but in interest rates? The MOVE index is the key to understanding market uncertainty in bonds. When people talk about market volatility, they usually focus on stocks. But there's also a volatility index for bonds, the MOVE index. If you care about interest rates, inflation, annuity income, this one matters. My name is Matt Maresh, your host, and welcome to Retirement Ready Nation, where we turn retirement jargon into plain English and strategy into peace of mind. What is the MOVE index? MOVE stands for Merrill Options Volatility Estimate. It's a real-time measure of expected volatility of U.S. Treasury yields. In other words, how much interest rates are expected to move in the near future. Think of it as the bond market's version of the VIX. What does it measure? The MOVE index tracks implied volatility in Treasury bond options across key maturities, typically 2, 5, 10, and 30-year U.S. government bonds. When the MOVE index is high, it means traders expect big swings in interest rates. When it's low, the bond market expects rates to remain stable. Why should I even care about this MOVE index? This is especially important if you're nearing retirement and depending on fixed income investments. Are you holding bonds or bond funds in your portfolio? Thinking about annuities or guaranteed income products? Or watching interest rates because they impact mortgage rates and borrowing costs? For example, when the MOVE index spikes, it often signals uncertainty in the economy. Things like inflation surprises, Federal Reserve decisions, or recession fears. How is it calculated? Let's break it down. The MOVE index is calculated using implied volatility of options on Treasury bonds. It focuses on 1-month option pricing across several maturities. Like the VIX, it doesn't show historical moves. It reflects market sentiment of what they think will happen next. The number itself is expressed in basis points of yield movement annualized. Let's dive in deep. If the MOVE index is reading 120, that implies traders expect a 1.2% move in Treasury yields over the next year. Since it's derived from 1-month options, its short-term expectations are then scaled to annualized returns. To make this clear, if Treasury yields are at 4% today and the MOVE index is at 120, traders anticipate yields could fluctuate between 3.4% and 4.6% in the next year. Now that we know what the MOVE index is, how do we read into that number? Below 80 generally means a calm bond market. 80 between 120 represents normal volatility. Above 120 signals elevated uncertainty. And over 150 suggests market stress or a major macroeconomic event. For comparison, the MOVE index spiked above 160 during the 2008 financial crisis and again in 2020 during COVID. The MOVE index helps investors track volatility, not in stocks, but in interest rates. If you rely on fixed income or retirement income products, this is a key metric to watch. It doesn't predict exact movements. It is an implied volatility of future movements of where the bond market thinks it may go up or down in the next year. If you found this information helpful, be sure to like and subscribe to Retirement Ready Nation today. Want me to break down another investment topic? Drop your suggestion in the comments below. I'd love to hear from you. This channel is for information purposes only. It should not be construed as tax, legal, or actuarial advice. Ashbury Boutique Wealth Management and the Leaders Group do not replace those professionals.